Perfect. All good. Thanks. Welcome to the 10th session of Community of Practice PeerUp series. My name is Nancy Learn, and I'm the Strategic Initiatives Coordinator here at Center for Social Enterprise in St. John's. The Community of Practice is an initiative led by Community Sector Council, Social Innovation Lab, and Center for Social Enterprise. We aim to foster capacity building and innovation among change makers and community organizations. Before we start, we acknowledge that the lands on which Memorial University's campuses are situated in the traditional territories of diverse indigenous groups, and we acknowledge with respect the diverse histories and cultures of the Beothuk, Mi'kmaq, Innu, and Inuit of this province. We often heard about questions around financial challenges, bookkeeping every now and then. And that's why we have this session for you. Today's topic is financial health for community organizations. We are very excited to have experts from EY to share their insights on financial strategies, governance, and risk management. This session will be recorded. If you do not wish to be included in the recording, you can now turn off your camera. Now I'll pass the time to Andre to lead the conversation. Andre, over to you.
Thank you. Yeah, just a quick thanks for our friends at EY for taking time out of their morning to give this presentation, some very early. Yeah, I think Yvette, you were gonna kick us off. We have a full hour here, so if there's time for questions, we can field those at the end.
Thank you. Hi, everyone. I'm very excited to join you today with my team of experts from EY. I am Yvette. I am based actually in Calgary, but I have ties to Newfoundland and Labrador. You may recognize my last name. Oh, it's not on here. It's Yvette Freak. So my husband's from the southern coast of Labrador. So we are here today with three presenters. I will get Sergio to share the slides, and we will be going over our topic, which is future-proofing your financial health. Sergio, just checking if we are able to get those up.
Is this one the one you want, Yvette?
We can't see anything
Yeah,
right
not seeing
now.
it just yet.
Oh, interesting. Okay, give me 1 second.
I can explain why we're here though. So besides being invited to the PeerUp session, we also are running what we call EY Connect Day as part of our corporate responsibility program, which is called EY Ripples. And we work with organizations across the country to bring or to help in any way that we can with our skills at EY. And that's why we've brought our team of financial experts to come and share a bit about the topic with you and with regards to nonprofit finances. So I can actually get us, oh, there we go. Thanks, Sergio. We can
Sorry, I
see your
thought you were.
desktop.
Yeah, sorry, I thought you were already there, but there we go.
Perfect. Why don't we jump to our intros so I can pass it over to you, Sergio, to introduce yourself.
Is this the one? Sorry, is this the one, Yvette?
That's the one. Thank you.
Perfect. So just on my end, real quick, I've been with EY for over 3 years, but I have over 10 years experience of management, coaching, and helping businesses with finance and budget planning. So yeah, I'm very excited to be here with you today and looking forward to the presentation. Gbemi, up to you.
Hi, everyone. Thank you for having us here. So my name is Gbemi Sola, but you can call me Gbemi without the G. I'm a senior financial analyst and advisor with over 10 years of experience, but I've been at EY for about 3 years. And I also have a CPA designation and a cybersecurity designation. So I love bringing technology to and data-driven insight to help organizations. So over to you, Taryn.
Yeah, so hi everyone. My name is Tiernan. I'm a little bit different than the other two. I have a little bit less experience, but I've been with EY for about a year now. Worked across assurance and advisory, but I'll be joining next October as a finance transformation consultant. But I've done a little bit of pro bono work in my own time consulting for various nonprofits. So I'm really excited to meet you all and happy to be here.
Thank you. So, as I said, I already went through EY ripples, but we will be sharing out the slides with all of you, so you'll be able to read these in detail. And yeah, I would like to pass it over to the team to get us started on the presentation so that we have time for questions at the end. So I'll pass it to you, Sergio. Thanks.
Thank you, Beth. Now let's dive into the first section of the workshop where we're going to be discussing the concept of non-for-profit health and the use of a health check framework to help you assess your own financial health and why it is particularly relevant given the external pressures facing non-for-profits right now, but honestly, always, right? So, proactively managing the financial health of your non-for-profit is critical to secure its future, of course, and to fulfill its charitable goals. Your financial stability directly influences trust with stakeholders and long-term sustainability. Whether it's on a day-to-day operational basis or long-term strategic basis, having a strong grasp on the financial health of your organization will ensure you are better positioned for better long-term success across different sections. For example, the resource allocation, which will allow you to track income and expenses closely to make informed decisions about staffing and investments in new initiatives. The regulatory compliance, which will ensure your organization meets legal and financial reporting requirements to avoid any potential penalties and maintain your charitable status. And of course, trust and reputation. Transparent financial reporting is crucial for maintaining credibility with donors, supporters, and the public, demonstrating your ability to manage funds effectively. Optimizing resource allocation by effectively tracking income, expenses, and budgetary allocations will allow non-for-profits to make informed decisions on how to best deliver their vision, including levels of employed resources or investment, or any other initiatives and campaigns that they may be planning. Complying with regulations, of course, as we mentioned before, and you already know, non-for-profits are subject to various legal and regulatory requirements governing financial reporting and transparency. Ensuring compliance with these regulations help charities avoid legal penalties and, of course, maintain that status. Maintaining trust and reputation, well, it goes with the name, right? The more that you can be transparent with your reporting, we will be able to maintain credibility with employees, donors, supporters, and overall the whole public. Demonstrating sound financial health for non-for-profits can enhance your reputation and inspire confidence in the ability to effectively steward funds towards their mission. Now, I know it can be tricky to know where to start when you are assessing and identifying better ways to future-proof your financial health, especially when you're running a non-for-profit. So to assist you, there are a number of resources and tools available online you can follow. One comprehensive example, which is built specifically for charities and NGOs, is the Charter Path Nonprofit Financial Health Check, which is a framework. This framework was developed by Charter Path, a UK registered charity, on a mission to chart the path between nonprofits, volunteers, and financial skills. EY teams have collaborated with Charter Path to incorporate their framework into this workshop. The Charter Path Nonprofit Financial Health Check framework aims to empower you and deliver your organization mission sustainability by providing actionable insights into your financial health across the main 4 pillars that it follows. Pillar number 1, which is financial strategy and management. Number 2, governance and reporting. Number 3, risk awareness and mitigation. And number 4, skills and resources. In this workshop, we will run through each one of these pillars in more detail, and we will explore specific checks you can undertake to assess this financial health that we've been discussing. We will also provide you with practical tips and tools to future-proof your financial resilience of your company and provide you with activities online in the appendix. Now, to start it, I'll pass it to Gbemi so she can walk us through the first pillar. Gbemi, take it away.
Thank you, Sergio. Okay, so we will start now with the first pillar, covering the steps you can take to embed a financial strategy and sound financial management practices in your nonprofit. Financial strategy and management can mean different things to different people, as it encompasses a wide range of activities and goals and perspectives, depending on the context in which it is applied, actually. In simple terms, financial strategy is long-term planning and big picture decisions, basically board-driven, while financial management is day-to-day operations and controls, which is driven by the management team. To ensure we are all on the same page, on this slide, you will find we've broken down the different processes, horizons, purpose, and the non-profit owner. We've also included examples of such activities or deliverables for each of these processes. Over the next few minutes, we will run through each of these processes in more detail and explain what it is involved in each of those processes, how they can help protect your financial health of your organization. And then we'll conclude with an activity to reflect on the financial strategy and management of your own organization. For record keeping, for instance, this has to be daily and monthly. Document transactions, activities, and all of those. It sounds obvious when it comes to record keeping. It's essential for your growth, for your nonprofit. Now, why is record keeping very important? It's the foundation for transparency, accountability, and compliance. It supports reporting, budgeting, and long-term planning. Types of records you could have for your organization include financial records and non-financial records. Financial records, for example, your income, your expenses, your payroll, your bank statement, while non-financial could include your volunteer list, your impact data, and permits or legal or regulatory documents. Transparency allows you to get more funds, and it shows other people or your stakeholders how your funds are being used. Compliance allows you to meet your tax and legal requirements and prevent fraud. Most importantly, record keeping allows you to make better decisions and allows you to plan as well. Some practical approaches. Storage of your record would also depend on the scale of your nonprofit. We advise, as organizations grow, you keep reviewing and upgrading your record keeping processes. This is recommended because as the organization grows, your needs will also grow and it will differ across different organizations. For example, a practical approach to record keeping would be your email and including sub-inboxes in those emails, and also including labels or using the labels in the email to help automate or streamline how you keep records when you receive an email. That is just one example of the many practical approaches available. Follow a retention rule and ensure data security. Bottom line, good record keeping is clear financial health. It increases your trust with donors and improves your mission success. How do your financial record flow into your financial statement? It is one thing to keep a ledger for all your financial records, but a ledger alone is not enough. Just tracking your income or your expenses is not enough. This is where financial reporting comes in. Financial reporting should ultimately provide you with the information your leadership team needs to review your organization's performance each month and to prompt discussions about your actions that the team or your organization may need to take. There are various types of financial reporting. We have the management account and we have the financial statement. Management account, firstly, they are internal to the organization. The exact content of your management account will be tailored to your nonprofit to ensure that this management account helps you and your team to track the performance and metrics you mostly care about, because different organizations may apply different metrics in their organization. However, commonly included in management accounts would include your income, expense, assets, liabilities, and any KPI, which is key performance indicators that you may be tracking. Your financial statement for nonprofit, these are typically produced once a year and often are mandated formats for consistency by external stakeholders. They will expand on the management account with comparison of the financial activities and performance between current year and prior year. This is majorly external and it's required by external stakeholders. While there's a lot of jargons used around financial statements, ultimately, there are three key financial statements that are important for your nonprofit. One, we have the statement of financial activities. This presents your financial activities over a period of time. For example, between January to 31st of December of a specific year, assuming 31st of December is your year end. Then we also have statement of financial position. I like to call this, it's a snapshot of your position at a specific point in time. It shows your funds, your assets, your liability, and all the cash that is available to your organization at a specific point in time. And the third other important financial reporting document is your statement of cash flows. This shows how cash has moved across the various months, the activities between the 1st of January, for example, to 31st of December, assuming that is your financial year end. Hopefully, this makes it clearer why record keeping is so important, as otherwise you risk having incomplete or inaccurate management accounts and or financial statements, with the result that both internal and external stakeholders will be unable to understand or access your financial performance and health. Financial ratios applied by your management account or financial statement. These are very, very important because it helps you to make decisions, identify trends. It provides insight into your financial performance and the efficiency of your organization. They are used by external stakeholders, and you can also use them as internal stakeholders. We'll be looking at some of the elements here. They are just great ways to understand your management account. Please note, those on the screen are not exhaustive, and you can always have more depending on your organization. But we'll look at these 6 key ratios. Surplus margin. What is a surplus margin? What it means? This means how much money is left after paying all your expenses. For example, your total income is $100 and you spend $90. Then you have $10 left. $10 over the $100 you got is 10%. So your surplus margin is 10%. Depending on your organization, you would set a benchmark for your organization. The same thing, we have fundraising efficiency. What does this mean? How much you raise compared to what you spend on fundraising. For example, you raised $4 and then you spent $1. That is a ratio of 4:1. And why this matters is because it shows if your fundraising activity is cost effective or not. And all the way, I could go on and on with different ratios, but like I said, this list is not exhaustive, but some ratios might apply to some organizations while some might not. So it's important for the team to find out what ratios are important and which is not. These ratios can be tracked to monitor how your organizations are performing. Right now, I just want to ask us, or if you could put in the chat if there are any ratios that your organization uses at the moment. You can put that in the chat. Well, when we get to the question and answer portion, we would continue there. Moving on, we'll talk about long-term planning, business plans, and 3-year financial plan. This is the final element of financial strategy and management, is long-term planning. With so much going on with your day-to-day running of your nonprofit, it can be very tempting to only focus on the year ahead. And even that can sometimes feel like a very long time, given all the external pressure that nonprofits expect or go through, or grant makers or donors' expectations. However, for nonprofit, grant makers, nonprofit regulators expect your organization to have a business plan and a longer-term financial plan. Sometimes, or mostly, this financial plan would look at how your finances will develop over the next 3 to 5 years time frame. This can feel like a daunting prospect. However, all this are already information that you already have in your organization. They are just principles or assumptions you already hold. Much of the needed data often exists already, so you just need to consolidate them and have them together. We will quickly explain the difference between a business plan and a 3-year financial plan and what makes up the constituent of a typical business plan, so it feels more achievable to bring one together. Starting with the business plan, it defines the mission, your vision, the goals, and steps to achieve them. To start to bring to life what a business plan looks like, we have listed out examples of different sections you may find in your business plan and have included them in the appendix. Regularly reviewing and updating your business plan is important. It ensures it remains relevant and responsive to changing circumstances. To ensure your nonprofit vision is attainable, the business plan must be underpinned by a solid financial plan. This plan should outline how your organization will operate and be funded over a typical long period of time, 3 to 5 years, like we stated. The 3-year financial plan mirrors the structure of your annual budget and your financial statement, but offers a higher level view of your financials. It will be based on your broad assumptions that you are making in your business plan as how your nonprofit offering will be delivered. Example, your services, how you want to increase that, the end users, and also external factors like the political outlook and how you are applying that to your nonprofit. The prospect of building a 3 to 5 year financial plan can be challenging. However, there are certain clear, simple ways that we can go about this. For example, we've broken this down into stages to make it more manageable. Set clear goals and priorities for your organization. Let the team be specific on what they want to do. Involve your key stakeholders, because the common thing is the team internally develops a 3 to 5 year plan without involving key donors, key funders, or even provide feedback to the board. Use historical data. All the information, all the record keeping you're keeping, use those information to embed in your 3 to 5 year financial plan. Furthermore, review and challenge. Constantly review and challenge what is working and what is not working. This is a chance to incorporate scenario analysis, best case scenario, worst case scenario, and things like that. Now we're going to have an activity. Note down for your nonprofit. You can do this in the chat. 3 things that you're doing well in terms of financial strategy and management. And then 3 things that you want to improve to strengthen the financial strategy and management of your organization. And then at the end, we would review together if time permits. Pass this on to Tiaten to take us further.
Yeah, so I'll cover pillar 2, which would be governance and reporting. So we'll explore how the roles and responsibilities of your board of directors kind of changes, and how the importance of policies and procedures can help you make the most of an independent review. So by the end of this section, hopefully you'll have a clear understanding of how good governance and accurate reporting can not only keep your finances in track, but also help you build trust with your donors and stakeholders. So what do we mean by governance and reporting? So this is referring to the framework of duties, practices, and processes, which provide structure to all elements of how an organization operates. And good governance is really critical in providing reassurance to stakeholders that the organization is well managed, and being held accountable to achieve its objectives. So there's 4 key elements to deliver best practice in terms of governance. So that would be transparent governance structures, effective board meetings, clear policies and procedures, and accurate financial statements. So now we'll touch on a few of these further. So how to establish transparent governance structures. It's really important that you establish clear roles and responsibilities for everyone in your organization. And this would go from part-time volunteers right up to board members. And everyone should be clear on their responsibilities and their authority to make decisions and kind of the start and end of who they are reporting to. So role descriptions and board committee charters are a very simple way of keeping track of this and providing transparency for all stakeholders. And these can include with them the approved responsibilities and authorities from a decision-making or a financial perspective. So for these to be helpful, it's critical that they're updated quite regularly and also shared across the organization, so there's that collective awareness. And on the right-hand side of the slide, you can see an example governance structure for a medium-sized nonprofit. So you'd have the board of directors who provide oversight for the organization as a whole, and they also appoint the CEO and oversee the CEO's performance. And this is optional, but you could have a sub-finance committee beneath this, which essentially would make and hear the outputs and decisions made in relation to finance, as they're all responsible. But then we would have the CEO. The CEO is responsible for appointing the management team and executing the strategic plan of the organization. So this would include the management of the organization's finances, and they would also ensure that they provide regular updates to the board and have appropriate policies in place. And then underpinning this, you'll have the finance team or lead who is responsible for managing the day-to-day finances. And this would be from the payment of invoices to the reconciliation of bank accounts, all the way through to the preparation of the financial statements and the forecasted budgets. So as you may know, in small nonprofits or charities, this person may have a finance background, they may not. But ultimately, they would have responsibilities that also extend beyond finance. This could be legal, operations, or really any other task. But that said, there is a responsibility on either the finance team or individual to really ensure that the wider nonprofit team is aware and adhering to all relevant financial policies and approvals. And all of these bodies, teams, or individuals will only be successful from a governance perspective if you really maintain open lines of communication with regards to financial matters across the board, subcommittees, the CEO, management, or any other team, so you can just have that collective awareness. In terms of effective board meetings, here we have an example, annual calendar of board meetings. So board meetings is really the second element underpinning good governance, and the board would be responsible for overseeing the organization and delivering its mission. So it's critical that these meetings provide the board with all information that they need to make the right decisions at the right time. In addition to making sure the board has the right information, it is important to make sure that the board is also made up of the right people, something we'll look at later in this session. There's also really no strict rules regarding the frequency of your board meetings, although it's likely to be set out in your governance document. But ultimately, it's important that the board members meet as often as necessary to really carry out their role in overseeing the organization's performance. So for most small and medium nonprofits, this would likely be a quarterly meeting with the potential for more meetings if any issues arrive throughout the year. So on the slide, we can see an example calendar for how you may wish to structure these meetings and cover the key financial topics in these meetings. I would say financial performance is very critical for every board meeting agenda. At the beginning of the financial year, this would be a review of the previous year's financial statements and consideration of any forecast, if anything has changed in your budget moving forward. And as the year goes on, the board can continue to review this budget and your quarterly results and also the latest forecasts that you're projecting to potentially approve actions required if performance is forecast to deviate significantly from the budget. I would say risk should also be a feature in board meetings. You're unlikely to view every risk in full each board meeting, You may want to split it up in terms of group or theme. So you could split it up as operational risks versus financial risks, but it's important to cover the key risks that your organization might face. And then other financial topics to be included in your agendas would be the preparation for the audit and review or audit findings by the board. So we'll also come to this importance in a moment. But most importantly, it's your minutes that need to be documented in terms of board meetings. Not every element of the discussions, but pretty much any decision made, key issues raised, and how they have been addressed, and any actions to be followed up on. In the same way that it's important for all individuals to have role descriptions, you should ideally have a charter of terms or reference for meetings, so you can ensure that the meetings flow well and are quite focused. So clear policies and procedures would be the third aspect of good governance. And here we have a few examples of finance-related policies. So these policies and procedures are really essential for good governance because they provide a framework of how an organization should operate. They also develop a clear set of principles to be followed or an approach to take to ensure things are done consistently across your organization. These policies tend to be high-level principles to be adhered to, whereas procedures would be the documents sitting underneath the policies to provide step-by-step guidance. And having these documents really provides clarity and accountability for employees and volunteers, and they would also be useful for new joiners to your organization. And they're critical for external stakeholders who may want reassurance that you have these rules in place. So on the slide here, we have financial management and reporting. You would define the internal controls and procedures to safeguard assets. Procurement would detail the procedures for purchasing goods and services. Expenses would outline the guidelines and procedures for reimbursing employees and volunteers. Cash management, you want strict cash management and procedures to manage the cash flow and balances of the business. And then reserves would set the guidance for maintaining or segregating adequate reserves to cover operating expenses. So there's many good templates for policies available online, and these would provide a great starting point for you. However, in order to be effective, you must tailor them to your organization and ensure that they reflect how you specifically operate and the different situations that your specific organization might face. You can make sure that you review them on a regular basis to ensure they reflect any changes in laws, regulations, or how your organization operates. And you can keep track who reviews them in the policy itself, so you can demonstrate that they're living documents, living, breathing documents. So some external stakeholders might be interested in your policies and procedures. So grant providers in particular often ask what policies you have in place to give them an idea of the level of governance. So it's just important to have these policies to develop a best practice in terms of governance. So the fourth and final fundamental component of good governance is the need to have accurate financial statements. As we discussed with the first pillar, providing stakeholders with accurate and timely information about your nonprofit's financial performance is really critical, and the accuracy of reporting is also paramount to maintain the integrity and reputation of your organization. So each year, your nonprofit should prepare a set of financial statements covering the financial activities, the financial position, and then the cash flows of the most recent year and prior year. The format of these statements will obviously be mandated by your local jurisdiction. It could depend on your size, geography, or constitution, and you may require an external sign-off or independent review of your financial statements. This could be in the form of an audit or an independent review. But they're both methods for essentially evaluating an organization's financial and operational practices, but they do differ in purpose, scope, and kind of who conducts them. So an audit is a little bit more formal. It's an independent examination of your financial statements to ensure accuracy. It's a little bit more comprehensive, and it focuses on the three financial statements, but it also includes transactions, testing controls, and assessing risks. And it's usually conducted by an external body or certified accountants or auditing firms like EY. And then in comparison, an internal review would be a little less formal evaluation conducted to assess specific areas of an organization's operations. It's more about improving efficiency, effectiveness, and internal controls rather than providing a formal opinion on the financial health of the business. So the scope can vary widely and kind of be determined by your specific needs. It could focus on certain departments, processes, or compliance, but it would typically be conducted by internal staff. So in summary, audits are formal, independent assessments with a broad focus on financial accuracy and compliance, while internal reviews are a more flexible, internally driven evaluation aimed at improving processes and internal controls. So that brings us to the end of Pillar 2 on governance and reporting. Before we move on to Pillar 3, sorry, you could put in the chat, think about a recent financial challenge your nonprofit has faced or is currently facing, and maybe how your governance and reporting framework can support you in overcoming this. But now I'll pass it off to Sergio to cover Pillar 3.
Thank you very much. Now let's move on to our third pillar of financial health, risk awareness and management. Every organization faces risk of delivering their mission, and when risks do arise, there is typically some form of financial consequence, unfortunately, whether it is a direct loss of funds, the cost of resolving the issue, or a fall in funding due to a reputational damage. Good risk management is therefore critical for the functioning of any organization to ensure its financial health. Of course, it is not possible to eliminate every risk because we can't control everything, but the aim is to manage the risk to a level in which we feel comfortable with, known as a risk appetite. What do we mean by managing risk? Well, that's the process of identifying the risk you face, assessing which presents the biggest threat, and then taking the steps to reduce the likelihood of them reoccurring or the impact they might have. Managing your risk can have some real benefits for your organizational financial health. First, it helps your financial planning. If an unexpected issue arises, it can disrupt your plans and force you to relocate funds to resolve the issue. However, if you are aware of your risk, you may make allowances for them, perhaps setting aside some contingencies so that they're covered in an event, and perhaps you'll have a lot more of a chance to stick to your budget if you have those in place. Second, it helps to make better decisions. Setting out all potential risks, considering the likelihood and impact, will mean that you are aware of what you're getting yourself into. If a risk actually comes to be, you will be ready and you have already factored the consequences. It will not lead you to regret making a particular decision. You can make your stakeholders aware of the risks too, so that they have no surprises. And finally, it helps you achieve your aims. The more you're able to stick to your financial plans, the better decisions, and you won't be knocked off course by unexpected events, the more likely you will be to actually deliver your mission. So, considering all potential risks that your organization faces may feel overwhelming. I know there's so many things, right? However, a risk register is a great framework to distill a lot of information and make it feel more manageable. You can categorize your risks by theme and present them in a clear way, which is an easy way to interpret for everyone from the board to your most junior employee. This is important as everyone has a responsibility in managing risk. It is equally important that the risk register is a real living document which is reviewed regularly to ensure it's up to date. In the world we live in, things change often and frequently, and new risks emerge quickly. If it is a theoretical exercise only reviewed once a few years, chances are that you won't be having the right controls in place, as an unexpected issue will definitely catch you. Too often, risk registers are relegated to the end of the agendas, and it's only when incidents occur that the board members recognize these should be on top of the agenda every time. So let's be proactive, not reactive. In this section, we're going to look at the 3 steps to build and use for improvement of your register. Step 1, identify all potential risks. Step 2, prioritize the risk with consistent scoring approach. And step 3, provide a clear path to mitigate and reduce these risks. Okay, so looking into step 1, which is to identify all potential risks that your organization faces. It is important that this exercise is done really thoroughly and that you get creative. You want to consider every issue that could arise and could have a negative impact on your charity and its availability to deliver its mission. Organizing a workshop with a good cross section of your team, and maybe even a few members of your board could be a great way to ensure that you consider all perspectives. Reflect on what's happening in your sector and, of course, the macroeconomic factors in the wider world. Think about the previous incidents and ensure these are incorporated. Of course, risk registers do need to be proportionate, right? You can include the risk of nuclear war. However, in all likelihood, if there was a war, well, nobody would be still be here, right? So it is definitely worth keeping a list of things that you have discounted so you can revisit it when you're performing subsequent reviews. On the right hand of the slide, we can see some examples of the types of risks for you to consider, from governance and operational risks to financial and reputational risks. Okay, moving on with step 2, which is to prioritize the risks to determine which you should be focusing and acting on. Risks by their nature are unpredictable. We know that. However, by applying a consistent framework, you can help to prioritize and rank them accordingly. On the slide below, we can have an example of a matrix for scoring the likelihood of each risk occurring and its expected impact. So for likelihood, you could score from 1 to 3, with 1 being remote or very unlikely, to 3 being the very likely risk. You might want to add some time parameters for this scale. For example, defining an event which is expected to occur at least 2 years is likely. Perhaps the risk of a cyber attack could only happen maybe, I don't know, 3-5 years, or something else more unexpected, like maybe bank insolvency, a bankruptcy, or something like that, that we don't see that often, probably every 20 years or so. So just, get them accordingly. Similarly, for the impact score, this can be scored on a scale from 1 to 3, with 1 being the minimal impact and 3 being a serious impact. In the same way as for the likelihood scores, you could add quantitative thresholds for these definitions. For example, if the risk was likely to result in the cost of in the cost to the organization of over 10,000, this might be classed as a serious impact. But if it was only 1,000, well, that might not be as significant, right? Some organizations like to consider 2 scores: the unmitigated risk score, which is the impact and likelihood of the risk assuming that you take no action and have no controls in place, then the mitigated risk score, which is the impact and likelihood of the risk taking into account the controls which you have in place. So either one you could use. This is a fair approach, but does increase the complexity of the register. You may also wish to use a more detailed scale for scoring, for example, 1 to 5 or 1 to 10. But be aware, the more that you increase the subjectivity of your assessment and potentially introduce more complexity of the process, it might be more complex for to be implemented. Once you have scored the likelihood and impact of each risk, you can then multiply the 2 scores to identify your highest score and risk overall. Check your scoring by assessing whether the highest risks are aligned with what your board thinks are the highest risks for the organization. If they are different, review your scoring to see if you need to tweak your definitions. It can also be helpful to plot the risk in a chart, such as this 9-box grid, which provides a good visual representation of the risks facing your organization and those which ones you should be prioritizing. So once you have identified your highest scoring risk, the next step is to review them and see what more can you do to prevent and reduce the likelihood of the risk occurring and minimize its impact. After all, it's all about mitigation of the risk. When looking at strategies to mitigate your top risk, you'll often hear about controls. In simple terms, there are just approaches or additional processes or checks that you have put in place in your non-for-profit to risk mitigation and have those strategies, and which will fall in the next 4 categories. The first one is risk avoidance, just the elimination of that activity, right? So a strategy in control here could be stopping the activity altogether. For example, a non-for-profit organization which is focused on youth development decides not to fund or host any overnight trips for children. Why? Well, there's concerns about potential risk of safety, liability, and of course, logistical challenges of providing accurate supervision. Instead, they choose only to provide day programs that can be a lot easier managed and controlled. Second one would be risk transfer. Transferring the risk to another party to mitigate the risk to the nonprofit. Example of this from controls perspective would be ensuring a part of your internal policies or sign-offs that appropriate insurance is in place across all key activities, ranging from general liability, insurance to property, cyber, and their directors and officers. And all this should be reviewed annually. So if you have an incident or an issue, the financial risk will be mitigated by this insurance that you will be able to claim and you would submit. So make sure that these insurances are definitely covered with any event or planning that you may be having. Risk reduction. That's the third one, taking proactive measures to reduce the likelihood or impact of a risk through improved processes, training, and technology. Of course, the more we know, the better we can perform. So if we're implementing additional controls or checks, for example, here, a charity that receives a cash donation, which will need to implement stringent controls around ensuring dual cash control. So we're going to have two individuals handling and verifying cash, reconciling cash collected with donation records by a separate team, requiring timely bank deposits within 24 hours, and restricting access to cash to authorized personnel only. These measures collectively enhance accountability, security, and transparency in handling cash donations. So it may seem a little bit straightforward, but sometimes because we think it's too common sense, we forget to apply them. Well, in this case, just make sure that we have that in writing. Also, risk acceptance. There are some risks that you may need to accept, as the cost to try and prevent them from happening may be more costly than the overall impact. An example might be the risk or a chance of legislation. Unless there's some indication that this is going to happen, you could spend a long time and a lot of money to predict the future, but we can't. So you're not going to get a lot of benefit. It is really important that these controls have a risk owner so that there's someone accountable to make sure that they're operating as expected. Testing the effectiveness of controls is something that you might be looking into on a regular basis, depending on the nature of the risk. So here we have an example of a risk registered, which demonstrate what it should look like. As you can see, it is relatively simple to read and understand. This will help your team and board members in terms of building and understanding what are your top risks and how are you managing them. Equally, it enables them to challenge your proposed controls if they do not feel comfortable with the mitigated risk score. If you produce it in Excel, then you can sort the risk based on their overall scoring to identify the highest ranked risk. So here we can take a look at the top one, right? For example, it has been brought up by the trustee body, which lacks relevant skills or commitment. The current status is following unexpected resignation of the treasurer. So that's a risk. Trustee board is lacking financial skills. Okay, so that's already high because it's already happening. So the likelihood is 3, it's right there, and the impact is 3, so it's high impact as well. What kind of controls do we have in place or have we identified to reduce and mitigate this? Where we're recruiting for a new treasury, and we have now training for the board so that going forward, if this ever happens again, we will be able to take this in a better way. So this is one of the ways that you can do it, and this is just one example of how a registry could look like for you. So we're going to take a quick pause here for an activity. However, since we don't have too much time, I would like for you to do it on your own. So if you want to note down the top 3 risks for your non-for-profit and assess the impact and likelihood of each risk to occur. Please note down what controls you have in place to mitigate them. And yeah, just make sure you have those. If you want to share with those in the chat, that'd be awesome. And perhaps if we have some time at the end, we can discuss. But if not, it's just a good eye opener so that you can start these exercise going forward. Now back to Gbemi to discuss the 4th pillar, financial skills and resources.
Okay, so as we reflect on the first 3 pillars of the health check, you might have started to think about some steps on what you want to improve and your financial health in these areas. Because of the interest of time, I'll try to skim through as much as possible. We could also send a presentation or deck at the end, and I know that the team is also recording these sessions. So financial skills and resources, basically, what do you need? What are those areas that you've seen gaps in your financial skills, and how can you get these resources? So first, attract. Sergio, let's just go to the next one. Thank you.
Yeah, sorry. I don't know what happened here, but we're here. Okay, carry on.
Okay, so when you're planning, just undertake a financial skill assessment regularly. Check what you have and what you need. And it can as simple as using a SWOT analysis. And also checking with your board, because some people on the board or volunteers might also have some of those skills that you need. Onboard appropriate financial resources and embed a culture of financial health. Everyone is in charge of the financial health of the organization, not just a finance team or a finance lead. So we would access some of this. However, we will not be touching on this table today because of the interest of time, and you could review this at your own time. Attract good resources because it's important for you to have those on your team. It's also important for you to recruit and do your due diligence and things like preventing fraud. You can have or consider a trial period or contract or think diverse and also get volunteers. When you onboard them, also provide training and share support. Sergio, you can go to the next slide, the next one. Thank you. So the culture of financial health should be embedded as a culture to everyone. It's a collective responsibility. Everyone in the organization has a role to play in ensuring its financial health. Proper record keeping, making sure that it's effective. One of the things you could do for your organization is to set the tone from the top, from the board to the management and everybody. Set the tone from the top. Promote transparency. Make it easy for everyone to report on whatever it is that they're doing and expense tracking. As simple as that. Make it easy to be able to report things like that. Education and training, like having this type of sessions periodically and just knowing what is going on in the industry. Set clear policies and accountability and connect finance to your mission success, because no dream can be achieved without money. Let's take another pause now and you can reflect on how you can apply this. Like we stated, because of the interest of time, you might not be able to do this activity, but it will be good for you to do this in your organization with your team as well. I'll pass it all to Tianan for him to wrap up.
Yeah, so thank you all for listening. I'll just give a slight recap here of everything we covered, and then we can kind of open it if we have time for questions at the end. So we spoke about what financial health is, and we introduced the concept of proactively instead of reactively future-proofing your nonprofit's health across the 4 pillars of the charter path. So these include financial strategy and management, governance and reporting, risk management, and then accessing these financial skills and resources. So like Sergio said, a lot of these things may seem like common sense and straightforward, but it really is just that framework. Oftentimes, non-for-profits can face more complex problems than even a for-profit would. And a successful organization is one that is organized. So these frameworks can really help you kind of sort through any issues that might face. And a further step as a part of applying these learnings into your nonprofits, we'll send out the deck and you can take some time to review it and reread these materials and then hopefully implement some of these tips and tools and frameworks into your actual organization. Yeah, I just want to thank you all for listening to what we have to say. I hope it was beneficial and informational to you. We have a few minutes. I'm happy to stick around for questions if anyone wants to ask, but yeah, thank you all for listening.
Hey, thank you. Tiernan, Gbemi, and Sergio. That was great. A lot of good nuggets and what a comprehensive presentation. So yes, if you share that over, we'll make it available to folks and the recording, of course. We'll keep the meeting open for a couple more minutes. If folks have to jump, totally understand. But if there's any other questions, yeah, if you can stay on Tiernan, appreciate
Yeah.
that.
Absolutely.
So if folks can drop their questions in the chat or raise your hand, up to you. This is a good opportunity to pick our expert speakers' brains. I have one question that I'll start us off with around reporting. So for organizations that actually no, Ben's got a question. So Ben, go ahead, come off mute if you want to ask.
Sure. Yeah, thank you. My question is related to risks around not-for-profits generating surpluses and how to best properly allocate those surpluses to be able to maintain our not-for-profit status.
So do you mean in terms of like managing the risk that a surplus of funds might have on your organization?
Yes.
Yeah.
We're not supposed to make a profit, but we are.
Like regulators, they often scrutinize like large surpluses, because obviously they want you to use these funds for charitable purposes. I'd say like really having a framework to kind of use these funds or like use them somewhere in your organization. Misuse obviously would breach any like donor agreements or funding conditions you might have. So it really goes back to that kind of financial management and strategy. Like if you have excess funds, just finding a place to put them really is quite important.
Okay, I'll just jump in right there. One of the things that you could also do would be to have a reserve policy, and that way you can best put your surplus funds to create a reserve. So making sure that you have a policy to back it up, that you have this specific reserve, and then you can also reinvest it in your mission and increase your mission work, maybe for a particular frame, come up with like a 3-month, 6-month stuff that you want to do for that period. So that could be one way of doing it. Or you develop an investment policy as well. And so that, or whatever it is that you're doing is back up with policies that you have in your organization and invest this and ensure transparency and compliance. But most importantly, you can also talk to your accountant or look for an accountant to talk to that this is what you have and how best to go about it. But if you create a policy for reserve, for investment, and have that for transparency, that could also help in the surplus management.
That is what we ended up doing, was creating reserves and then putting motions in our minutes, allocating those surpluses into reserves for future projects that align with our mandate. So thank you.
Thank you for the question.
All right. And then Derek from the Newfoundland Labrador Composting Cooperative, you put in the chat here, fundraising risk as a new co-op requiring innovative public fundraising. Plan on recruiting a board member with this background and in the meantime brainstorming on the topic to find solutions. It sounds like the question here might be risks around recruiting a board member for fundraising skills, or Derek, feel free to add anything to that.
Yeah, like we mentioned, there was one risk on the example. Yeah, recruiting is definitely very important. You have the specifics that you're looking for, but perhaps adding training to all the staff that's already in place might also help in the future so that they know as well in case you have someone that someone is not the only person that can do the job and oversee different perspectives of the organization. So that way you can mitigate it in a better form.
Yeah, I would just add, like, in terms of recruitment, I think for nonprofits, it can be hard to find people that want to work for a nonprofit. So it's really aligning that mission and vision that your organization has. I think also with recruitment, it's important to hire results rather than a resume. Just because someone has good experience and you might think they are capable of the job, I would value results rather than just a brand name almost. But yeah.
All right, thank you. Any other questions from the group? Going once. Okay, if not, I think that's a good place to, oh, wait. Yeah, thanks, Heidi. Good advice. I think that's a good place to leave it for today. Thanks again, EY team, for making time for us early in your day and for sharing your insights.
Absolutely. Thank you for having us.
Yeah.
Thank you for
the
having
invite.
us.
Thank you. Thank you for the lectures. It's
All
wonderful.
Have a
right,
great day. Bye.
thanks
Bye.
everyone.
You too. Bye.
Thank
Bye.
you. Bye.